Welcome to SB Talks. Today is Thursday, October 10th, and I am joined, as ever, by our Chief Investment Officer, Nick Ryder. Welcome, Nick.
Thank you, Vinny.
Now, Nick and I today will be discussing geopolitics and the escalating conflict in the Middle East, what we take from the US Fed meeting minutes released last night, and reflection on the last quarter, and outlook for the rest of the year. Welcome to all our listeners. Nick, I'd like to start with geopolitics this week. Since we last recorded, there has been a significant escalation in activity over there. We've seen incursions now occurring in South Lebanon. We've seen direct Iranian involvement. Probably the highest tension we've seen in the region for maybe a decade or two. How much does this cloud or influence your investment decision making? Not just, I guess, what's occurring, but the potential of further escalation with more direct conflict with Iran and Israel?
Yeah, I think I might have mentioned on previous podcasts, typically these events can create a little bit of uncertainty in financial markets. Mm-hmm. So you might get a bit of a equity market reaction and a rally in the bond market as people sort of swap into safe havens. Mm-hmm. You sometimes see gold do reasonably well. I think this time around,
markets have been pretty resilient to it so far.
They've been pretty resilient. You know, you have to remember this conflict's been going for a year now, and this is just the latest iteration. In terms of what it might mean, I think it's probably the second order effects. So, for example, if Israel does retaliate against Iran, and it's been speculated they might try and take out some of their oil facilities, their oil refineries, and
potentially some of their nuclear facilities as well.
Or potentially the nuclear facilities. But I think markets are more concerned about the impact on the oil market, and so we've seen the oil price go from $71 to $81 in pretty short order on the back of that. So that's a sort of risk premium built into the oil price. Cast your mind back to the war in Ukraine, where we saw a huge impact on oil prices.
In the early days of that.
And then that had a second order impact on inflation and food prices, given oil is such a major input into fertilizer and things like that. So I'm more worried about that sort of second order effect. So if we did get, some damage to Iran's oil facilities and the oil price went up $10, $20 a barrel.
Obviously now there's embargoes against Iran exporting oil, but the reality is that they are still a major source of supply into the world market. Yeah,
well, they've been supplying oil to China, who's skirting those sanctions. It's hard to know because there's still spare capacity in Saudi Arabia. So Saudi Arabia could equally just sort of ramp up production, and other OPEC members could ramp up production to offset the impact to Iranian production.
Supply.
So it depends whether it's 1 million barrels a day taken out or 2 million barrels a day, and for how long. But it's more that sort of second order effect and what that might mean for inflation and sort of broader risk markets. But I think the sort of short-term impact is fairly minor.
And markets have been quite resilient to it so far. So as an asset allocator, you don't feel there's a need to build, I guess, more protection into portfolios at this point, any more so than there has been over the last year or 18 months?
No, definitely not. I mean, that's really the only impact is on uncertainty. But we have a lot of uncertainty anyway with the US election in less than a month. So I think it's very difficult to prepare portfolios just for these one events. And as we've discussed, it really hasn't had much impact on financial markets so far, except through the oil price. And even that has come back. So the oil price went up to $81 for Brent, and it's back down to 77, so almost halfway back down to where it was before all this happened.
Yep, been a bit more downward pressure on it from there. Now, you released your quarterly this week, and an excellent summary of the last quarter. Probably one of the main stories in there has been a bit of the journey. Equity markets have been on over the quarter, and probably the correlation between that particularly and the anticipation around what the US Fed was going to do and rate cuts / recessionary risks. We had Fed minutes last night. Where do we sit on that one? Obviously, recently we had the 50 basis point cut. We talked about it on the last time we recorded. Potentially bigger than had been expected, albeit expectation had built towards it in the immediate days prior. How do you reflect on the last quarter and also where we go from here in the US?
Yeah, I mean, I think the markets have really been dominated over the last quarter by, there was that sort of, if you might recall, that soft July non-farm payrolls print that caused a bit of consternation. There was a spike in the unemployment rate. The SARM rule was triggered, which is often a recession indicator. And clearly the Feds reacted to that. They were worried about it, and that was the real reason why they cut rates 50 basis points at the September meeting. Looking at the minutes last night, it does seem like Jerome Powell sort of directed that. So even though most participants agreed with the 50 basis point cut, there was quite a lot that still thought a 25 basis point cut was probably more warranted. And subsequent to that meeting, we've had the non-farm payrolls report for September, which was very strong. 254,000 jobs created, well above the 140 expected. There were also upward revisions to the prior 2 months, including that weak July one. And that's sort of...
Where prior the trend had been always downward revisions in some of the previous ones. So it's sort of not just a strong number, but it bucked the prior trend of sort of downward revisions of prior numbers.
Absolutely. And it really is. And that SARM rules now is not triggered anymore. Right. And so this time is different. And so I think, it's really sort of seen real repricing in the rate outlook in the US over the last few weeks, last week.
Yeah, so immediately after the last meeting, there'd been a question mark over, does the next move be another 50 bips? How much do we get before Christmas? What is the market now telling you?
Yeah, well, so the market had been around 75, maybe 80 basis points price, so that's 3 cuts, or a bit over 3, the next 2 meetings between now and the end of the year.
So a further 75 on top of...
We're now down to 45.
Right.
So less than 2.
Yeah, so perhaps 1 cut, perhaps 2. Yeah.
Probably 2. So there's probably 25 at the next 2 meetings. So the market's sort of gyrated really over the past quarter on this employment data. Very data dependent, the central banks and markets too. So that's really dominated markets. But
it's worth probably reinforcing the positive story in that that gyration we've had is sort of because the economy's proving resilient.
Absolutely. I spoke about that in the quarterly. People are now of the view that, yes, they've pulled off the perfect soft landing. Growth in the US is still very strong. The economy is growing 3% at the moment. Employment's still reasonably strong, and inflation is coming down. So, in the Fed minutes last night, the majority of participants took the view that inflation risks have diminished. And although unemployment risks have increased, so that's kind of where they're sitting at the moment. So I think it's a good story.
The bond team soft landing.
Yeah, team soft landing. The bond market didn't like it too much, so we've seen a bit of repricing there. But equity market loves it. They like the soft landing story, even if rates don't come down as much. It's the growth outlook is still better.
It's generally a healthier picture. If the economy is reasonably strong, you're not slashing rates, but you are bringing them slowly back to what might be considered a neutral level. That means the economy's, going in the right direction.
Well, that's right. I mean, I think there's still a question mark as to where rates finish up. This neutral rate that we've discussed before. The economy's obviously done well with rates in the US of over 5%. It hasn't slowed the economy down that much.
Remarkable, again, when we consider where they come from and rates at 0, essentially.
So do they need to go back down to 3 to 3.5, which is sort of where people are penciling in the sort of terminal rate in 2025? Maybe not. So we'll see. We'll see how
based on those
Fed
minutes, they can slowly make their way there and see what the economy's telling them, what the data's telling them. Yeah. A positive development.
Yeah, it's been good for risk markets. So, bonds did 4% over the last quarter. Equities on a hedge basis about 4.4. Aussie equities. So there's been a real rotation as well into sort of more
let's talk to that and what's happened even in the Australian share market over the quarter.
Yeah, so as rates come down, more cyclical companies tend to do better. So things that are more exposed to the economic cycle improved. So we've had a real sort of bounce in sort of more value stocks. We also had a little bit of disappointment around the Mag 7 and concerns around how much they were spending on AI.
They're growing, but are they growing just fast enough to justify those eye-watering valuations?
Yeah. So the market's rotated, and then last week we had that huge China stimulus announcement.
Yeah, let's talk to that, because we've talked China many times on the podcast, and it's been a pretty gloomy story for much of the last year. All sorts of challenges in their property space and no obvious solutions. So what have they brought now to the party?
Yeah, so they've cut mortgage rates, they've cut interest rates, they've cut the reserve requirement ratio, which is the amount of capital banks have to hold. They've reduced the down payment on your second home purchase. Right. So they're really sort of loosened things up there.
A lot of their lending restrictions going. Yeah.
They've provided some funding for companies to do share buybacks and a stabilisation fund for the equity market. So they're really trying to put a floor under the property and equity market.
And their equity market has just not had any love for quite some time. But there has been a positive response to this.
That's the monetary stimulus. Yeah. I think then the focus has turned to fiscal stimulus, and there were some headlines saying they're going to, potentially 10 trillion yuan or 2 trillion yuan, and so we don't really know what they're going to do on that front. I think this weekend there's some announcement, potentially put more details around that. But people are saying it's the Mario Draghi whatever it takes moment for China, where they're going to throw money. Obviously monetary stimulus and fiscal stimulus at the economy to try and put a floor under it. So that's been positive. Chinese equities have had they rallied 26% over about a week. They've since given back 8%, so they're up 18%. But I think it's been good for commodity prices. Iron ore prices have had a lift. So copper prices.
Australia's benefited from some of that.
So we've seen a rotation in Australia away from banks actually into the miners.
And the banks had run so heavily. We talked about it here that hard to justify some of their valuations. So suddenly it's given reason for investors to think about other sectors away from the banks.
And it's been great for the managers, active fund managers that have really, haven't been overweight the banks, and so they're now seeing some of the stock picking decisions paying off. So it's been quite good for them. Yeah.
Interesting. Anything else catching your eye?
The only other thing I would say is that we've seen some more recent data in Australia showing things maybe improving a little bit at the margin. So we had the monthly inflation report that sort of was a little lower. We've had business confidence and business conditions improve. We had consumer confidence yesterday, bounced 6%. So at the margin, things look like they're okay in Australia. I think as inflation comes down. As we get some of those sort of tax reductions and subsidies come through,
the impact of the subsidies,
they're all helping a little bit. And I think also people can maybe see that rates aren't going to go up, and the possibility that rates might come down at some point over the next 6 months.
Yeah, and that was going to be my next question. I guess people possibly seeing a little light at the end of the tunnel. What's your read as we sit today, and when that we're really not any further move up unless there's some significant change in the data trend. When do you think that rate relief comes to the consumer segment?
It's hard to know. It's very data dependent, but I think the money's probably early next year, February, something like that. I mean, we did get the RBNZ did their second rate cut yesterday. They did a 25 to start the cycle. They did 50 yesterday.
But they'd gone harder.
They're going harder. They're saying there's a lot of excess capacity in New Zealand, and they might even do a 75 at the next November meeting.
But I mean harder than they'd risen to higher
absolutely.
levels.
They've got up to 5.5%.
So they got more room to move on the way down.
Yeah.
Very interesting as always, Nick. Excellent summary of everything. Thank you again, and thanks to all our listeners.
Thank you.
Take care.